Hello everybody, this is Said Teski. We talked in the previous video about periodic inventory system and how we can manage inventory using that system, and we said that there is another system that we can use to manage inventory, which is the perpetual inventory system. In this video I will be talking about the perpetual inventory system, and we'll see the main differences between the perpetual inventory system and the periodic inventory system. And at the end of the video I will be talking about which system is better and what is the advantages of each system. Let's see what is the perpetual inventory system. In perpetual inventory system, the inventory account is increased every time merchandise is received. So every time we buy merchandise, we have to increase inventory account, not purchases account as in periodic inventory system. And at the time of the sales, two things will happen. Inventory account will decrease and cost of goods sold account will increase. Let's see in numbers what does this means. Okay, when item is received, let's say we bought change the color here. Let's assume that we bought $2,400 of merchandise. At the time of the purchase and when the items is received, we will increase the inventory account, because inventory account is an asset account. To increase it, we have to debit that account. So we will debit inventory by 2,400 and for any accounting transaction in double entry accounting system, we have to do each financial transaction should affect two accounts. So here we have affected the first account, which is the inventory account. What do you think is the other account that we have to credit? Because we have bought inventory, so we should pay for it, or we should put it on accounts payable. So let's assume that we paid for it in cash. So we will credit cash by the same amount. Okay, so at the time of the purchase and when the item is received, we have to increase inventory account and decrease either cash or accounts payable. Okay, this is at the time of the purchase. Okay, when items is sold, what should we do? When items is sold, here it's saying at the time of the sales, two things will happen. Inventory account will decrease because we are taking things out of our warehouse, out of our inventory. So this is the credit side, because to decrease an asset account we have to credit it. And in the debit side we have to debit cost of goods sold. Cost of goods sold will be in the income statement. So let's see what will happen. First we have to debit cost of goods sold. Let's say the sales was $200 of inventory, and we have to credit inventory by 200. And also, because it's a sale transaction, we have to increase sales account, and we have to increase cash account, because when we sell goods, we'll receive money and our sales account will increase, because sales account will be in the income statement. To increase our net income, we have to increase sales account. Sales account, to increase it, what should we do? Debit or credit? We have to credit sales account. So credit sales, say these 200 of inventory, we sold it for let's say $300. So we have to increase cash as well by 300, because we have sell it for 300 and we have received in cash 300 from our customer. Okay, to make sure that our adjusting entry is correct, we will sum all the debit side and all the credit side, and it should be equal. So 200 plus 300 will equal to 500, and in the credit side you have 200 and 300, which is 500. This is a good habit to have, that always make sure that all the debits equal all the credits.